In this video, we're going to describe the accounting for investments in equity securities, with an emphasis on those investments where the investor owns less than 20% of the shares of the investee and is considered to have little, if any, control. Equity investments represent ownership interest of capital stock, and the cost will include the price of the security, plus any broker's commissions and fees related to the acquisition or purchase of the shares. The extent of our ownership stake generally determines the accounting treatment for our investment. If we own less than 20% ownership stake in our investee, we're considered to have a passive interest. In other words, we don't have a lot of say in the operations of the corporation, and we'll account for the investment using the fair value method. On the other hand, absent any other evidence to the contrary, in investing interest between 20 and 50%, the investor is considered to have significant influence and will use what's referred to as the equity method. Finally, if we have more than a 50% ownership, in fact anything from 50% to 100%, we have what's referred to as a controlling interest. We get to vote our shares, and we can basically dictate what that underlying investment or subsidiary will do. And I use the word subsidiary because we use what's referred to as the consolidation method, using either a cost or an equity method. That's typically a subject of advanced accounting courses. So, less than 20%, passive interest, and we use the fair value method. Between 20 and 50%, we're assumed to have a significant influence, and we use the equity method. And above 50%, we're assumed to have a controlling interest, and we follow consolidation accounting. So let's go ahead and look at those categories one more time. Categories are valuation method, how we account for unrealized holding gains and losses, and then some other effects. So holding less than 20%, we use the fair value, and any unrealized gains or losses are reported as part of net income. And we'll recognize dividends when declared and received, and gains and losses from the sale of our securities. If we hold between 20 and 50%, we use the equity method. We don't recognize any unrealized holding gains or losses, again, because we're not accounting for it at fair value. And we will record our proportionate share of the investee's net income. And dividends will be considered a return of our investment and reduce the carrying value of that investment. And then finally, holding more than 50%, having a controlling interest, we use the consolidation method. And again, we do not recognize unrealized gains and losses because we're not using a fair value method. And the other income effects aren't applicable because of our consolidation accounting. Again, under the fair value method, companies will report their equity investments at fair value and record unrealized gains and losses as part of net income. And our only exception to that would be if the fair value of that equity investment cannot be determined. That's a fairly complex topic which we won't cover in this chapter. Well, rather, it is covered, but we won't cover it. Let's go ahead and take a look at an example. We've purchased the common stock of 3 different companies, and we hold less than 20% of the outstanding shares of both Northwest, Campbell, and St. Regis. And there's the cost of our investments. If we were to receive a dividend from one of the companies, let's assume a Republic company, we receive a $4,200 dividend from Campbell Soup, we record the cash and we record dividend revenue. There's no journal entry impacting the equity account or investment account on our books. At year end, though, we're going to need to do a fair value adjustment. So we're going to want to compare our cost, which was the $718,550, with a fair value of $683,000, and we can see it's gone down, so we're going to have a fair value adjustment to decrease the value of this equity investment. And we will want a credit balance of $35,550 in our fair value adjustment account at year end. If we assume that the current or previous balance was 0, we're going to need to credit the fair value adjustment account by $35,550. And we will record an unrealized holding loss. And again, that flows through on our income statement in the amount of $35,550. Let's go ahead and take a look at a few more examples. We're told that the Sheffield Corporation purchased 440 shares of Sherman Inc. common stock as an available for sale investment for $12,900. Again, we don't necessarily plan on trading this way right away, but again, since it's common stock, we can't classify it for hold to maturity. So it's just available for sale. And we do not have a significant influence, so we're holding less than 20% of the outstanding shares. During the year, Sherman paid a cash dividend of $3.25 per share, and at year-end, Sherman stock was selling for $34.50 per share. Let's go ahead and look at the journal entry we're going to record at the time of the purchase. Again, we were told the purchase price was $12,900, and that would include the price of the securities plus any brokerage commissions and any other fees related to the purchase. So we debit equity investment for $12,900 and of course credit cash for $12,900. During the year, we received a $3.25 per share dividend. So we're going to debit cash for $1,430. That's the 440 shares times $3.25 per share. And we credit dividend revenue. We're told at year-end that common stock of Sherman was selling for $34.50. Again, we have to use the fair value method for accounting for our equity investment. And we're assuming our fair value adjustment account had a zero balance prior to year-end. So what do we need to do? We need to take the difference between our market value and our carrying value. Our market value is $15,180. That's the 440 shares times $34.50 a share. And we subtract off our $12,900 cost. And we see that we're going to need to debit our fair value adjustment to increase the carrying value of our investment on our books by $2,280. And we will record an unrealized holding gain that will become part of or be reported as net income. So again, that's the fair value at year end of $15,180 minus the investment's cost. We've got a few more questions to look at. Our first question is, what percentage ownership indicates that an investor does not have significant influence over the investee? That would be less than 20%. And what method should be used for this level of ownership? That was the fair value method. And at what amount is this equity investment reported on the balance sheet? That's going to be, in this case, the $15,180, which was our fair value. Recall, 440 shares times $34.50 per share. And is the unrealized gain included in net income or below net income as part of other comprehensive income? And it's reported as part of net income. Again, this is because it is. And how do we account for dividend revenue? Is it part of net income or below the line in other comprehensive? It also is reported as part of net income. We've got another question related to our fair value adjustment. Assume our fair value adjustment account had a debit balance of $1,000 prior to our year-end adjustment. What entry do we need to make? Well, again, we've determined above that our fair value adjustment account needed to have a balance of $2,280. So how do we get there? If we've got a $1,000 debit balance, we're going to need to debit our fair value adjustment for $1,280. And of course, we will credit an unrealized gain, holding gain, which becomes part of net income, in the same amount of $1,280. One last question. Now let's assume our fair value adjustment account had a $1,000 credit balance prior to year end and are making our adjustment. What entry do we need to make? Well, we still need a fair value adjustment account with a debit balance of $2,280. And again, that's the difference between our fair value and our carrying value. We're going to need to credit the fair value account for $3,280, and we will report an unrealized gain of $3,280. Again, the difference between the current balance in our account and the required year-end balance. These are similar adjustments we do with our allowance for doubtful accounts, or rather bad debt expense, when we use the allowance method. We compare the ending balance, what it needs to be, with what it currently is, and we make an adjustment for the difference.